Welcome to the latest edition of Behind the Charts. I'm Dave Keller, the Chief Market Strategist at StockCharts.com. Today we'll feature a conversation I had with Doug Ramsey from the Leuthold Group in Minneapolis. We've actually talked to a number of people in the Minneapolis area, guys like Craig Johnson and Jason Geffert and Jeff Hughes and many others. It's a hotbed of technical analysis, and much of that comes from the Piper Jaffray technical research team. Steve Leuthold, who founded the Leuthold Group, where Doug is the chief investment officer, worked at Piper Jaffray and pioneered a lot of the work that they did. We'll talk about the Major Trend Index, which is basically one of the long-term trend-following models that the Leuthold Group has kept updated for decades, and Doug is now responsible for. Doug has a background in mathematics, in quantitative analytics, and he brings that sort of mathematical rigor to his analysis of the financial markets. Ladies and gentlemen, here's my conversation with Doug Ramsey from the Leuthold Group. All right, so we're here with Doug Ramsey from the Leuthold Group. Doug, it's awesome to sit down with you. I've known you and followed your work for a while, and you're at a firm whose work I've known. I think a lot of people certainly know of Steve Leuthold and the legacy that he's provided. What the funny thing is, you're not the first person we've spoken to in the Minneapolis area. I would say Minneapolis may be the number one city we've talked to between Craig Johnson and Ralphat Kampora, Jason Geffert. It's a hotbed of technical wisdom, I feel like.
Well, the winters are, 9-10 months a year, so there's plenty of time for reflection and cozying up with the fire and a stack of charts.
What better than to look at charts, right? So listen, it's awesome to sit down with you. I'm really excited to get some of your expertise and wisdom out to some of our viewers. Can you start us from the very beginning? Where are you from originally?
Grew up in eastern Iowa, Cedar Rapids, and ventured out to a small college 6 miles away from my house, right there in Cedar Rapids, College. Right. And got enthralled with economics. I majored in economics undergrad, and I've come to learn this is not uncommon that those that get enamored with economics undergrad, especially at a small school where you get to know your professors. I think there's some pressure on them to maybe try to steer you down that path professionally, and it certainly happened to me. And I played basketball at that small college, but I had three buddies that were on the football team that all went on and got doctorates in economics, and I was initially headed down that path. I went to Ohio State, and I had some family history at Ohio State, so it was fun to be out there. My daughter's about to graduate from there in 3 weeks, so I don't regret that. But I tell you what, master's in economics, or a PhD in particular, it's heavily mathematical. I would have been far better off in that program had I majored in math and not economics. I mean, it's far easier to be taught the economics with a math degree than vice versa. So it's not, I did fine in the program. I mean, I cut it short with a master's degree. Just out of really sheer luck, hooking up with a firm that was looking for a guy with a master's in economics, or an individual, let's say, with a master's in economics. So I escaped academia. That was in 1990. It was funny. Thank goodness.
I'm glad you brought up the Ohio State University, because I certainly would have made us go there had you not brought it up originally, because we had that shared part of our academic past. But it's funny. I had a liberal arts education there, and I took one course in economics. It was an honors economics class, and it was all econometrics. It was all math, basically. So it was funny to me. I certainly see what you're saying. It was a very quantitatively oriented things. And when I'm looking at your background, there's certainly a quantitative bent to a lot of the roles that you've had, right?
Yeah, absolutely. And that's originally, I think, what attracted me to the technical realm was the idea that some things could be tested. But started out, there's an old saying, and maybe this is too extreme, but economists have an idea of what the market should do. Technicians pay attention to what the market's actually doing, or words to that effect. I don't think I quite got it as glib as the original quote, but I've come to believe, there's like a happy medium between those two, that you can't, just purely rely on the charts, that there does need to be some economic or some fundamental conviction underpinning things. Otherwise, you just might get whipsawed too often by the chart work. But I think there's there's a happy medium between those two. At times in my career, I think I've balanced them well. I think in the past couple years, didn't foresee the extent of the onslaught of the monetary deluge. That's been difficult, and then just valuations in the market have sort of held my firm back, and principally me as the lead asset allocation person here, from playing this rebound as aggressively as we could have. But certainly the chart work and all sorts of technical work have helped in that regard. I mean, we haven't been bearish. We've just not been as fully allocated as we could have been in the last 13 months.
It's interesting. I want to talk. There's so many things I'd love to ask you about, but you sort of alluded to this relationship between the technical, the quantitative, the fundamental, the economic, and there are all these sort of moving parts that are together. And when I think of your work, and I think of some of our meetings we would have, and the Green Book, which is just a fantastic repository of market wisdom that you guys put out, I think of it as being a nice combination of all those different disciplines. How do you think about that balance? What's the balance? When you see the chart saying one thing, but you see the fundamental stories and the economic stories, something. How do you sort of reconcile those sorts of differences?
We've for almost 5 decades, we've run this major trend index, which, and we've had some recent adjustments to that, Dave, where, the mix of the economic and the sentiment, supply, demand, and the technical, it's a little bit more flexible. Let's take back to 25 years ago. I mean, the tech bubble from 97 to early 2000, that was a difficult period for a major trend index because of the overwhelming weight we had then put on the valuation work. And you were at valuations that had never before been seen, really, from 1996 onward. So that was a difficult period. I mean, the good thing is our equities on the long side did so well that actually our core fund negotiated that period on a risk-adjusted basis really well. And that's sort of what's happening here more recently, is that our industry group analysis, where we buy, essentially strong groups. I mean, there are certainly fundamental factors. That is leading us into the right areas. We're just not as aggressively invested in terms of net equity exposure as we could be. So that's an example of the balance, but I struggle with it. What's the right amount of weight to put on this incredible flood of liquidity that the Fed's supplying? Clearly, they're going to tolerate far higher inflation than they ever have before. I mean, it's hard to balance that against the valuations you've already achieved just 13 months off a major bear market low. You're at valuation measures that certainly rival on the S&P 500 what we saw at the peak in 2000, and the average stock is far more expensive than it's ever been. This is the most expensive broad market in history, period, end of story. No question.
And also, I mean, the valuations certainly extended the sentiment. I mean, the euphoric sentiment sort of readings that we've seen, right? There are a lot of similarities between those two periods. You mentioned the major trend index, which I'm glad you brought up. That's one. I mean, when I think of the work that you guys do, the major trend index always comes to mind because that's something many of us would refer to. Can you talk a little bit about what that is in particular? Because it sort of aggregates a bunch of different inputs into one conclusion, right?
Sure. And, I alluded to some recent changes there. It's 4 categories, and we've chosen to use terminology that's just simpler and more industry standard, but we have a valuation category. And I mentioned that's been the stumbling block, in the past few years in terms of having a more aggressive allocation to equities in our tactical funds. But a lot of it's S&P 500, various measures of earnings, but rather than look at trailing earnings, which right now are very depressed, or forward earnings, which might be inflated on the upside more recently, we do a lot to normalize earnings and cash flows, that sort of thing. So it's about 20 measures looking at valuation, and also just looking not just at the S&P 500, which is very expensive, but also the average stock. Like mid caps and small caps are very expensive, but actually look cheap compared to the S&P because the S&P is so high. So it's a variety of measures, all of that stuff rates pretty extreme right now. On the other hand, within the what we are now calling the cyclical category, this is sort of a catch-all for Fed liquidity, interest rate movements, earnings estimate revisions, just various different cyclical indicators of risk on, risk off. That is positive but trending lower because of the increase in bond yields and because of some of the leading inflation pressures we're seeing right now. So positive but diminishing. I think we're past the point of peak liquidity supporting this market. A third category would be sentiment, which I think this is true of a lot of technical related work. It's very good at market bottoms, not quite as much so at market tops. I mean, I'd argue that sentiment, from a contrarian perspective, is probably in better shape than it was 3 months ago when we had that big GameStop squeeze. You were just seeing a lot of our sentiment measures going through the roof.
Crazy.
The market hasn't sold off. The contrary, it's about 10% higher than it was 3 months ago, and sentiment has improved. So it's very good at market bottoms, but very often the peak in sentiment or speculative fervor occurs before the peak in prices. So from a timing perspective, it's certainly much better than valuation, but it's got some of the same problem, is that extreme froth can go on in investors' minds for a long period before the market's really in serious trouble. And then the final one, near and dear to both of our hearts, is now we call it the technical category. Previously, we called it momentum breadth divergence. So we just simplified the names of all these categories, but that's a mix. And again, this is an art, even though there's a lot of science behind the individual inputs, trend following, counter trend, there's still a decision you have to make as to how to weight those relative things. So I think breadth right now is pretty solid. A few weeks ago, we saw a few cracks, but very quickly this 8-9% rally in the S&P and more blue chip than broad market in the last month. That's resolved all of those issues. The trend stuff is all good. And I don't see just a lot of internal divergences that concern me. So we are, if you would have told me that here we are challenging the valuation extremes we saw in March of 2000, yet we're still, 57, 58% net equities in our core fund, where our allowable band is 30 to 70%, I would say that's pretty darn aggressive considering how high those valuations are. So again, and that comes down to a risk tolerance. Our tactical strategies are about smoothing out the ride through a cycle. In more difficult periods for the stock market, let's say 2000 to 2009, that's a wonderful time to be in things other than all stocks. That was a great decade for us. In the last 11 years, the trend has mostly been up. And in the last 3-4 years, it's really been to valuations that I didn't think that I would see again in my lifetime. And that's maybe a mental handicap or mental bias I had, that it would have paid off just to have purely looked at the charts and not had this bias that, hey, that original bubble 1.0, the tech bubble, late 90s, that was a once in multi-generation event, or so I thought.
Right.
And well, here we are again. And as I said, the broad market's far more expensive than it was at the top of the bubble 21 years ago. So in some ways, it's more extreme.
Yep. It's fascinating stuff. As you're talking about the different components of this model, you're describing an investment process that I hope people recognize is so well designed. I think in terms of thinking of all these different inputs, it's worth noting you're at the Leuthold Group. You're manager of some Leuthold funds. This is named for Steve Leuthold, which, is one of the, CMT Association's annual award winners. He's been certainly a name that I hope people know. But for those that don't, who is Steve Leuthold? Can you talk about him and the impact he's had just on the firm, but also more broadly?
Sure. Steve was an investment strategist and investor for really about a 50-year period. Started out as a retail broker and had a lot of early success using the charts. And he had been introduced to the charts doing some by hand point and figure work for a higher up during his brief stint in the military. I think it was commodities, actually, now that I recall, in the late 50s, but just became fascinated with the idea of charting and became a successful retail broker, then became the market strategist at Piper Jaffray in the late 60s, and just built a lot more fundamental meat around the original technical bones, but it was always a healthy mix of the two. As a matter of fact, during the 1970s, Steve wrote a book, I think it was actually published in 81. It's called The Myths of Inflation and Investing, looking at the interrelationship between PE multiples and the stock and inflation rates. And I think we're gonna revisit that here.
We need to dig that book up again.
I mean, so what goes around comes around. But then Steve went out on his own with Piper's blessing in 81, formed the Leuthold Group. The first copy of the Green Book, as you mentioned, came out in September of 1981.
That's
and
correct.
Steve wrote in that book until 2008 and was the primary author and a great delegator, I might add, in terms of providing direction for ancillary research studies. Was personally involved in the calculation of that major trend index every week up until that was until 2011, and then he formally left the Leuthold Group at the end of 2011. I mean, he's still a minor shareholder of the firm. We all have a good relationship. I wish he were still actively involved in markets. I mean, he's really not. He's 83 these days. But I took over calculation of that major trend index in 2012. And, again, even though there's a lot of science behind it, my own personal biases have crept into it. I've pulled back the impact of the valuation on the overall MTI reading, although in recent years that wasn't enough. We've just blown through, again, what I thought we would probably achieve anytime in my lifetime. So I guess, that's maybe a vote in favor of the chartist sort of agnostic. There's no price that's too high to buy, and no or too low to sell.
I was always told never confuse the top of the page with resistance, is what I was told at a growth-oriented technical research team. That's how it was described to me.
Well, there's a great line, and I don't know if it's been uttered yet on this podcast by a previous interview subject, but I think it was Phil Roth who said that the problem is that a technical analyst thinks a stock chart and the company fundamentals are different. A fundamental analyst thinks that they're the same. Does that sound right? I might have gotten that wrong. You might have to edit that out, Dave. Or Google the correct. Sounded so good in my mind.
No, I think that's it. It's all about the relationship between them, right? And it's funny that many think of them as the same thing, right? You buy a company and that's it, and in reality, they're two separate things, right? You gotta think of them independently.
Yeah.
When you're talking about your role in particular, it reminds me of our conversation with David Lundgren, who was at Wellington for a number of years and a portfolio manager driven primarily by technical analysis. And you are another person we're talking to who really wears a couple hats, right? Part of your role is to provide research, but another part is to actually generate good returns. Can you talk about the differences between those two skill sets, or how you take the inputs and apply them in a research approach versus a money management approach?
I thought you said you wanted to keep this interview under 2 hours. No, 20 minutes. I've done so much soul searching on that, and I guess what I'd say, and I came across, a lot of people I think have articulated this pretty well, but the issue with being an analyst and marketing an opinion is that you tend to become wedded to that opinion, and that turning your tail on that opinion, even if it's the right thing, can be seen as a sign of weakness by research clients.
Yeah.
So I do think that's a challenge because there are just times when the world changes, and March 23rd of last year was one of them. Our S&P 500 valuation work didn't get close to anything like we'd seen even at the most expensive bear market low back in October of 2002, yet that was the low. I mean, the Fed more or less bought the market low and the economic low. When you have an opinion on the table, and it's in print, there's pride of opinion that's involved, and I think it makes it very challenging to do both well. Whereas if you're a portfolio manager, and even better inside a mutual fund rather than a separate account where people can see what's going on, in a mutual fund you can sort of change your mind under the cloak of secrecy, and I think it's a great advantage. But I think our clients on the research side recognize that reality, and I tend to think if we do have to have an abrupt about face, and quite frankly I wish we would have had more of them. And every investor, published or not published, would say the same thing. But I think there's a particular challenge involved, and I know I was going to attribute George Vanderheiden from Fidelity actually had a wonderful recent piece relating to that, where it was actually a reprint of something that he discussed in late 2000 after he had just left Fidelity.
Yep. Yeah, one of the quotes that we've heard is, "It's okay to be wrong. It's not okay to stay wrong." Yeah. It's one of the toughest things to do, right? Is sort of
it is, and you know what? For us, maybe there's a blurred line between speculation and investment, and I've read a heck of a lot about speculation and technical analysis and all the Market Wizards books, but at the same time, I understand that it's very difficult to pull the trigger at the top, and that's part of why the extreme valuations have provided somewhat of a ceiling for us, and that helped us enormously a year ago for about 5 weeks, because we were underexposed and certainly didn't know how severe the COVID downturn was going to become. But so we were light to begin with, and then the charts broke, so we got really light on equities, and it made our year. We certainly didn't play the rebound as aggressively as we could have. But we did protect on the downside, which is a big job, and I think it's going to be a big job in the next few years. And I'm not going to get any more specific than that, because the thing's got a head of steam. The Fed's going to tolerate higher inflation than it ever has before, and the stock market has become a target variable for them. So I think it's going to be very difficult, but I think reducing exposure as the thing climbs higher is not a bad thing to do. And the problem is the chartist in you would disagree with that. So it's a balance, Dave. I mean, and I'm a huge proponent of the CMT program and the CMT organization. But in a tactical fund, there's a balance.
That's in life and in investment management, there's a balance, right? Listen, this has been awesome, Doug. It's worth noting, you mentioned you played basketball earlier in your life. And I should point out that when we would meet in person, you were one of the few people that would come in and tower over me. I'm pretty tall myself, but you were one of the few that had me by a couple inches. So
it's not, it was good.
Zoom call yet.
It was good until about that last college basketball game. And since then, I've had some health problems. And
Right.
So it's not been great. I think Stan Druckenmiller's about my size. So between Stan and I, we're worth about $5 billion. And I think Stan's worth about $5 billion.
Well, listen, Doug, this has been fantastic. Listen, I have great respect for you, what you guys do at Leuthold, and the legacy of the firm, but you in particular. I've enjoyed getting to know you and your work over time, and you were doing the Ohio State University proud. Having a good sense of the markets and communicating them well. So thanks so much for sitting down with us today. Appreciate it.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.